Talk about the bond yields and after hitting that 3-month high on Monday, the RBI came in, announced the operation twist, and you finally see the yields easing about almost 9 bips or so. But let's try and understand what really are the implications of RBI's move and what does it really mean for your debt investments. Lakshmi Iyer joins in the show. Lakshmi, hi, good morning. Good to have you in the show. Finally seen a bit of a cool off coming in after gaining all the way to that 3-month high on Monday on the yield. What is your own outlook on the yield now, Lakshmi, especially post the RBI MPC minutes and the operation twist announcement?
Yeah, hi, good morning. There are a lot of conflicting signals in the market currently, and that confusion is actually not letting the bond market settle at the current juncture. So for starters, while we did see a status quo on interest rates in the monetary policy decision, and the fervor to maintain an accommodative bias, the minutes seem to have revealed a very different picture, especially with some of the members, talking a little bit hawkish, at least the markets perceive that. That coupled with the inflation numbers which got released for July has actually led to this uptick in yields, everything else remaining constant. Therefore, my conjecture is that Reserve Bank of India had to step in to kind of, calm the nerves, because left to itself, the bond yields wouldn't have been where they are right now. So I think some little bit of stability coming back to the market. It's too early because the amount or the point at which where we were, about 5.8 on 10-year to where we inched up almost 0.5%, the pullback has not been that substantive as yet.
Yeah, exactly. And most experts that we've been chatting with say that more measures are needed to try and cool off the bond markets right now. What tools, though, Lakshmi, do you think the RBI has? Will we need more operation twists to ease the bond market?
So globally, we are seeing that incremental rate easing as a monetary tool is not having the extent of impact that it should have, especially the long end of the yield curve. Short end, I do agree, the anchor is obviously the benchmark rates to some extent. But I think world over, we are seeing whether it's the US, whether it's the Eurozone or the Japanese authorities, they've all been buying the long end of the bonds, and pretty much in the form of either an operation twist, which is what our central banker is doing, or buy outright bonds to give some sort of an anchoring effect at the long end of the yield curve, which I think is very important, not only for the markets specifically, but also for the economy. So I think that's very important. And more important is the continuity. See, it cannot be ad hoc. We have seen 2 back-to-back announcements. One is happening this week, and there is one happening another week. The amounts are very insignificant. So will 20,000 crores really soothe the nerves? Interim, yes, because the yields are backed up. The liquidity is very abundant. So the anchoring of the yields right now is happening more from the surplus liquidity. So I think more than rate easing measures, we require a combination of sustained outright bond purchases or operation twist to ensure this momentum continues.
Debt has seen FI outflows since March, turned positive only in August. What's your view when it comes to FI flows in debt and equity?
Yes, pretty much. I think while there has been a comeback on the equities front, where there is, globally liquidity is actually chasing the momentum play in equities. In fixed income, while some of the emerging markets are actually getting flows, I think predominant flows of foreigners are being diverted towards buying the US bonds, even the high yield bonds, because the Fed out there is actually buying even the very low rated assets. You flip it to India, there is this uncertainty on the medical front. There is uncertainty and vulnerability on the impact of currencies, including the INR. Though our currency has displayed a lot of resilience, I think it's a combination of these two factors that is leading to FPI outflows. We have been talking to a few asset allocators. the carry is very compelling. I mean, look at the absolute yields in India. The sovereign curve itself is offering you north of 6% YTM. And if you construct a very nice PSU plus a sovereign bond portfolio, the YTMs can, on these portfolios with a 3 to 5 year duration, can actually be north of 6.6 to 6.7%. So I think it's the currency which is probably inhibiting some of these moves to make a comeback into India. It's very early days. Out of 7 to 8 months, just barely 1 or 2 months have been positive. Bulk of the periods we've been negative, but slowly but steadily there is appetite, at least inquiry appetite, which has started returning back to Indian bonds.
Sure.